Okay, let's unpack this. Have you ever looked at a financial chart, seen all those lines and numbers, and just wished, you had a secret decoder ring, a way to truly understand what the big players are really doing behind the scenes?
Yeah.
That's exactly what we're diving into today. We're exploring Wyckoff 2.0, Structures, Volume Profile, and Order Flow by Rubén Villahermosa, and also pulling some key ideas from the Wyckoff 2.0 Trading Interview Blueprint.
Right.
Our mission here is pretty simple. Give you a shortcut to understanding this advanced market analysis. We want to distill these complex concepts into clear, actionable insights.
Make it usable.
Exactly. Think of it as gaining a significant edge, understanding the why behind market moves, not just reacting to the what.
And what's really fascinating here, I think, is how this work takes these foundational principles, some like over a century old, and brilliantly adapts them to today's lightning-fast electronic markets.
Yeah.
It's not just about memorizing patterns. It's about understanding the logic. Why do these patterns appear? That helps you connect the dots, really enriches your understanding, makes your analysis way more robust.
Okay, so let's start with the cornerstone, the original Wyckoff methodology. For those maybe already familiar, what are its core ideas, and why did Rubén Villahermosa feel the need for a Wyckoff 2.0? Is the old way broken?
Well, not exactly broken, but maybe incomplete for today. The traditional Wyckoff method, it's all about interpreting market moves through supply and demand, right? Looking for the traces left by the big institutional traders, the so-called composite man. Wyckoff 2.0 isn't a replacement. Think of it as a crucial evolution. Today's markets are just fundamentally different. Electronic trading, algorithms everywhere.
Totally different beast.
Exactly. So a rigid textbook application of the original approach, it can be incredibly misleading. The real advantage of 2.0 is adapting those timeless principles. Supply and demand never goes away, but adapting them to modern tools and conditions.
So it's less about sort of robotically labeling schemes from a textbook
Yeah.
and more about understanding the underlying logic of accumulation, that big institutional buying and distribution, the selling, especially in these electronic markets.
Precisely. The book really emphasizes that no two structures look exactly alike. The market develops less conventional structures more often than the perfect textbook examples.
Okay.
What's really crucial is the action as a whole, the overarching logic. Accumulation comes before an uptrend, distribution before a downtrend. That basic logic holds, regardless of the precise visual shape. It demands, a high level of open-mindedness from a trader. You can't be too rigid.
That distinction between price and volume then becomes really critical, doesn't it? Lots of traders treat them sort of equally, but in Wyckoff 2.0, Rubin makes a pretty bold claim. He argues one is more relevant. Which one is it, and why does that matter so much?
Yeah, this raises an important question. While both are absolutely crucial, you need both. The author asserts that price data is certainly more relevant than volume data.
Really?
Well, think about intraday volume. It can be incredibly misleading because of session times. You naturally see way higher volume right at the open of the U.S. S&P 500 session compared to the middle of the day.
Right, the opening rush.
Exactly. And that could bias your analysis if you're not careful. Price, on the other hand, it incorporates all the information. It's just the graphical result of all executed orders. And it's reflected faithfully regardless of the session time or even the specific exchange you're looking at. It's kind of the unfiltered signal.
So price shows the what without those time-dependent biases, but volume adds the crucial context.
Precisely. You wouldn't want to trade without volume? Absolutely not. But understanding its potential for bias is key. For an intraday trader, the best way to avoid confusion is probably to compare price and volume across different session types. Or, maybe simpler, just focus on the daily chart. That naturally smooths out some of the session noise.
And to cut through noise even more, especially in these fast modern markets, the book introduces advanced charts, things like tick, volume, and range charts. What's the main benefit there? Why use those instead of just standard candles?
Yeah, these charts basically take the time variable out of the equation. Instead of updating every minute or 5 minutes or whatever, they update based purely on activity. A tick chart prints a new bar after, say, 500 transactions. A volume chart prints after a certain number of contracts or shares get traded. And a range chart prints a new bar only after price moves a specific amount, like 10 ticks.
Okay.
Their value is cutting through that time-based noise. You get to see market activity purely through transactions or price movement, which is sometimes reveal clearer patterns than a standard time-based chart, especially in very choppy or very fast conditions.
Now, The market, you called it a living entity. It rarely gives us those perfect textbook patterns. So what happens when a structure, maybe something that looks like accumulation, appears to fail? How should we read that? What does it really mean for someone trying to trade it?
Right, this is key. Don't think of failed structures as your analysis failing. Think of it as the market revealing its true hand.
Ah, okay.
If what looks like accumulation suddenly collapses and price breaks down hard, the insight isn't that the accumulation failed, it's that it probably was distribution all along, maybe disguised.
Got it.
It forces you to question your initial read and adapt, rather than just stubbornly sticking to a label. It really highlights two crucial unknowns we always face. We never really know the true intention of all traders. Are they playing short-term or long-term? And we don't know if some higher capacity traders, the really big fish, might suddenly intervene and shift the balance. The key, the book suggests, is to operate in favor of the last imbalance. What was the last decisive move? And often that's triggered by a shakeout, what Wyckoff called a spring in an accumulation, or an upthrust in a distribution.
And what about terms like structural failure and shortening of the thrust, or SOT? How do those subtle clues help us gauge potential shifts in market strength before they happen?
These are more subtle, yeah, but powerful contextual clues. Structural failure is when price just can't quite reach the expected boundary of a structure it's been developing. If it keeps failing to make new lows in a potential accumulation, that hints at underlying strength. If it keeps failing to make new highs in a distribution, that suggests weakness.
Okay, like it's running out of steam.
Exactly. It's not necessarily an immediate reversal signal, but it's a warning flag. Similarly, shortening of the thrust, SOT, is when you see each new push, each new high or low, travel a shorter distance than the previous one. It clearly shows a loss of momentum, both signal exhaustion, a potential shift in the underlying balance, urging you to be flexible and open-minded to a change.
So the emphasis is always on that open-mindedness, because the market is this living entity.
Yes, absolutely. Every moment is unique. Wyckoff gave us incredible guidelines: how markets move, the processes of accumulation and distribution, the three fundamental laws. But an advanced Wyckoff trader, using Wyckoff 2.0, learns to identify structures and imbalances even if they don't look ideal or fit the textbook perfectly.
Right.
You focus on the underlying market condition, the logic, not just the labels. And this idea of fractality, how these smaller patterns fit inside larger ones, is a recurring theme. The core logic applies whether you're looking at a 5-minute chart or a weekly chart.
Okay, let's shift gears slightly. Moving beyond just the chart patterns, the book gets into today's trading ecosystem. Who are the major players actually shaping prices now, and how do they operate in this high-tech world?
Understanding the players is crucial, yeah. The book breaks them down by their intent. You've got hedging participants just trying to reduce risk, like an airline buying oil futures. They don't really have a directional bet.
Okay.
Then arbitrage players exploiting tiny price differences, often very fast. And then speculation, these are the ones taking on risk for profit, with a clear directional view. Think hedge funds, prop traders.
So they're the ones really driving trends.
Generally, yes. While hedging and arbitrage affect liquidity and short-term moves, it's the speculative traders whose actions really add sustained pressure and drive those larger trends. And we can forget central banks, of course. Their monetary policy set the whole backdrop, affecting liquidity and overall sentiment in massive ways.
And how do electronic markets, especially things like algorithmic trading and high-frequency trading, HFT, fit into this? That sounds pretty intimidating for, say, a retail trader trying to use Wyckoff.
It does sound intimidating.
Yes.
Since around 2007, exchanges went almost fully automated. Algorithmic trading just means using computer code, complex models to execute trades automatically, leveraging speed.
Right.
High-frequency trading, HFT, is a specific type of algorithmic trading, operating in microseconds, often profiting from tiny price discrepancies or providing liquidity. And yeah, HFT accounts for a huge chunk of volume, like over 50% in U.S. stocks.
So how does Wyckoff 2.0 even work against that?
Well, the book offers some reassurance here. The argument is that HFT doesn't massively disrupt structure-based analysis like Wyckoff. Why? Because mostly we're not competing on the same playing field. HFT often deals with the very short-term, almost random side of the market arbitrage, market making. Wyckoff aims for the more deterministic side, figuring out who's actually in control over longer periods.
Okay.
The structural framework of Wyckoff actually helps filter out a lot of that short-term HFT noise, gives you the bigger context so you're not trying to beat the bots at their microsecond game.
The book also flags things like over-the-counter OTC markets and dark pools as potential issues for volume data accuracy. What are those, and why are they a problem?
Right. These affect data transparency. OTC markets aren't centralized exchanges. Trades happen directly between two parties, maybe over the phone or a private network. Think forex, for example.
Hmm.
The problem is a lack of transparency. Multiple order books, maybe slightly different prices, and the volume data you see from your broker might not represent all the activity.
Okay, fragmented.
Very fragmented. And dark pools are private exchanges, basically, where big institutions trade huge blocks of stock anonymously. They do this to avoid moving the public market price against them.
Sneaky.
Well, efficient for them. But the issue for us is that these massive transactions aren't reported immediately, sometimes not for 24 hours. So significant transactions may have taken place in a hidden manner, as the book says. That hidden volume can definitely influence the public market later, adding uncertainty to the real-time volume you see on your chart.
So that leads to the big philosophical question, really. Are markets fundamentally random or deterministic? Where does Wyckoff 2.0, with all these complexities, stand in that debate?
The million-dollar question. It's a huge debate in finance. The book suggests markets are likely a mix of both randomness and determinism. You have the efficient markets hypothesis on one side, basically saying prices reflect all info, making prediction impossible, pure randomness. Then you have models suggesting some predictability. A more modern view is the adaptive markets hypothesis, AMH, from Andrew Lo, which suggests market efficiency isn't static. It changes with conditions and how different participants interact. It acknowledges people aren't perfectly rational.
Makes sense.
Wyckoff methodology definitely aligns more with the deterministic side. It's built on the law of cause and effect, that a period of accumulation, cause, will lead to an uptrend, effect, and distribution leads to a downtrend. While HFT might represent some of the randomness, Wyckoff aims to uncover that underlying institutional logic driving the bigger moves, making it still very effective.
Okay, let's pivot back to volume. We talked about its biases, but the book emphasizes the importance of volume using auction market theory, AMT. How does AMT help us understand volume's deeper role?
AMT is a really useful lens, influenced heavily by J.P. Steidlmeyer and his market profile work. It basically says markets are always trying to facilitate trade, like an auction, seeking efficiency or equilibrium. When buyers and sellers generally agree on price and are comfortable trading, the price tends to range sideways. That's equilibrium or balance. But when new info hits or sentiment shifts, causing disagreement, one side gets more aggressive, takes control, and pushes price away. That's inefficiency or imbalance, which we see as a trend.
So it's a constant cycle, balance, imbalance, balance.
Exactly. The market moves from one area of balance, equilibrium, to another, driven by this ongoing search for fair value where trade can happen efficiently again.
So in this constant auction, what are the key elements that actually define value for the participants? What are they looking for?
There are three core elements according to AMT. Price, obviously, which acts as the advertising mechanism discovering levels. Time, how long does price spend at a certain level? Longer time suggests more agreement. And crucially, volume, how much actual business got done at that level. That represents the activity, the interest. High volume at a price level means high perceived value. Lots of participants were willing to trade there. So the synergy, price plus time plus volume, equals value. That's what guides participants to where value is currently perceived.
Now, the law of supply and demand is fundamental, we know that, but the book points out some common errors of interpretation that even seasoned traders can make. Can you walk us through those? Because this feels really critical for understanding how price actually moves.
Yes, this is a huge clarification point for many people. It sounds simple, but the common understanding is often flawed.
Okay.
Error, #1. Believing prices rise simply because there are more buyers than sellers. The reality. For any trade to happen, there has to be one buyer and one seller, always perfectly matched.
Okay, so what is changing then?
It's the attitude, the aggressiveness. Are buyers aggressively hitting the ask price, or are sellers aggressively hitting the bid price? That's what drives price, not a simple numerical imbalance of people.
Got it. Aggression, not numbers. What's the second error?
Error, #2. Thinking demand just means buying, and supply just means selling. The reality, in market mechanics terms, is that supply and demand technically refer to the passive limit orders, those resting orders waiting in the order book, the buy and E and ASK columns. That's the available liquidity.
Okay.
Price moves because aggressive orders, market orders come in and hit those passive limit orders, consuming the liquidity at one level and forcing price to the next level to find more.
So it's really about initiative and exhaustion rather than just thinking more buyers.
Precisely. Initiative is when aggressive traders actively push price. They eat through all the passive orders at one level and force price discovery at the next. Exhaustion is the flip side. It's a lack of interest from the opposing side to step in and stop the move. Exhaustion can actually facilitate price movement because there's less resistance. Price can move further on lower volume sometimes if the opposition has just given up.
And at the moment of a market turn, say, the top of an uptrend, what's the typical three-step process we might see involving this initiative and exhaustion?
It generally follows a pattern: exhaustion, absorption, and initiative.
Okay.
So, to reverse an uptrend, first you'd see signs of buyer's exhaustion, maybe shortening of the thrust, less momentum. Then comes absorption trade. This is where large operators might start selling passively, absorbing the remaining buy orders without aggressively pushing price down yet. They're building a position. Finally comes initiative aggressive selling, hits the market, confirming the turn, breaking key levels. That three-step protocol, exhaustion, absorption, initiative, is basically a microaccumulation or distribution playing out. You see it on all time scales.
So how does volume profile build on this auction market theory to give us a much clearer, more objective picture of where this value, this agreement actually lies?
Volume profile is incredibly objective, yeah. It simply grabs the total volume traded at each specific price level during a set period, usually shown as a horizontal histogram next to your price chart. It's not an indicator making calculations, it's just a different way to visualize the raw volume data.
Okay, so what are the key parts we need to understand on a volume profile chart?
Let's break down the critical bits. The value area, VA, that's usually the range where about 70%, technically 68.2% of the volume occurred. It's the market's comfort zone, where most trading happened, signifying accepted value.
Right.
Right in the middle of that, usually the biggest bar, is the point of control, POC or VPOC, the single price level with the most volume traded. Think of it as the fairest price during that period, the point of maximum agreement.
Okay, the peak.
Exactly. Then you have the landscape of the profile. High volume nodes, HVNs, are those other distinct peaks or bulky areas in the profile. They represent high interest, balance, and often act like magnets, pulling price back towards them.
And the valleys?
Those are low volume nodes, LVNs, thin, quiet areas with very little volume traded. They represent imbalance, rejection. Price tends to move quickly through these LVNs because there was little agreement or interest there. They often act as support or resistance.
That visual makes sense. Now, what's the difference between a finished and unfinished auction in a volume profile? What does that tell us about potential future moves?
Good question. A finished auction typically shows tapering volume towards the top and bottom edge of the profile. It suggests prices far from the main value area were explored and rejected. Business is done for now.
Okay.
An unfinished auction, however, often has a high volume node right at the extreme high or low of the profile. It looks like it got cut off. This implies there was still interest to trade actively at that edge, suggesting price might need to revisit that level later to resolve that unfinished business. It's a subtle clue about potential future targets.
We often hear about vertical volume versus horizontal volume. Can you clarify why volume profile, the horizontal view, is so important if we already have the standard vertical volume bars at the bottom of our chart?
Great distinction. Vertical volume, the classic bars at the bottom, tells you when activity happened.
Yeah.
How much volume traded in that specific minute or hour or day.
Right.
Horizontal volume, the volume profile, tells you where that activity occurred at what price levels. They're complementary. Vertical tells you the total contracts traded in a time period. Horizontal breaks it down and shows how those contracts were distributed across prices within that period. That price-specific granularity is what vertical volume doesn't show, and it's key for seeing acceptance, rejection, and fair value.
The shapes of these profiles also give clues, right? You mentioned P shapes and B shapes earlier.
Yes, the overall shape tells a story. P-shaped profiles often look like a capital P. You see an initial move up, imbalance, then price rotates and builds value higher up. This suggests bullish sentiment, maybe reaccumulation.
Okay.
B-shaped profiles are the mirror image, like a lowercase b. Price moves down first, imbalance, then rotates and builds value lower down. This suggests bearish sentiment, maybe redistribution. These shapes visually capture the market, pausing a trend, phase A in Wyckoff, and starting to build a new range, phase B.
Okay, so bringing it all together, how do we actually use volume profile in practice? What are the objective takeaways for trading?
It offers several really objective uses, which is its strength. First, identifying structures. VP can really help clearly define the boundaries of Wyckoff accumulation or distribution ranges, especially when the price action alone is choppy or unclear. The edges of structures often align neatly with LVNs or the value area high-low.
Okay, clarifies the messy bits.
Exactly. Second, determining market bias. By seeing where the current price is relative to key VP levels like the VPOC, the value area, and significant HVNs and LVNs, you get an objective read on who's likely in control. You generally want to trade in the direction values migrating.
Makes sense.
Third, analyzing trend health. In a healthy trend, you'll see the value area and the VPOC consistently migrating in the direction of the trend. That shows acceptance of new prices. If they start overlapping heavily or migrating against the trend, it's a warning sign the trend might be losing steam. And fourth, calibrating position management. This is huge. VP levels provide objective places for stops and targets. LVNs are often good spots for stop losses because they represent rejection. HVNs and VPOCs are natural targets because they represent areas of high agreement where price might pause or reverse.
Okay, volume profile sounds incredibly objective, but then we get to order flow, and the book highlights some significant problems with relying solely on it. What's the issue there?
Yes, order flow analysis is much more subjective, especially if you use it in isolation. We're talking about tools like the order book, or DOM, showing pending limit orders, the time and sales, or tape showing executed orders in real time, and footprint charts, which visualize executed volume inside each price bar.
Right, the really granular stuff.
Uber granular. But the core problem lies in interpreting the matching mechanism. It's easy to assume, for example, that all volume hitting the ASK side is aggressive buying, and all volume hitting the BYD side is aggressive selling. But it's not that simple.
Wait, why not? That seems logical.
Because a single action can show up differently depending on the order type used. For instance, if someone closes a short position with a buy market order, that volume appears on the ASK side, looks like buying aggression. But if they close that same short using a buy limit order to take profit, it appears on the BD side. When a seller hits, it looks like selling occurred there.
Ah, okay. That's confusing.
It is. The software tracks the aggressiveness of the order hitting the book, but it cannot know the trader's underlying intention. Was it opening a new long, closing a short, hedging, arbitrage? This ambiguity leads to tricky situations like delta divergence, where price might be falling hard, but the delta, aggressive buys minus aggressive sells, is positive. It shows complex order matching is happening beneath the surface.
So given that subjectivity, when is order flow actually useful? Should we just ignore it?
No, not ignore it, but use it strategically. The author strongly suggests limiting its use primarily to confirming entries or exits within key operating zones, zones you've already identified, using the broader context from Wyckoff structures and volume profile levels.
Okay, so it's for confirmation, not discovery.
Exactly. In those high probability zones, you then zoom in with order flow, looking for specific signs that large speculative traders are actively stepping in to support your trade idea.
So how do we actually read order flow in those key zones? What specific patterns are we looking for to confirm that institutional intent?
You typically read footprint charts diagonally, comparing the volume executed at the BID of one price level with the volume executed at the ASK of the level just above it. This helps gauge the battle between buyers and sellers at each step.
Okay.
What you're looking for are specific patterns. First, imbalances. This is where volume on one side, say the ASK, is significantly higher, maybe 200%, 300%, 400% or more, than the volume on the diagonally opposite side, the BID below it. It signals very one-sided aggression at that point.
Got it. Lopsided fights.
Exactly. Second, you look for turning patterns. These usually involve a combination. First, absorption. You see large volume traded, but price struggles to move past the level, often indicated by imbalances getting trapped. Price closes against the direction of the imbalance.
Yeah.
This shows passive limit orders from big players absorbing the aggression. Then you need to see subsequent initiative. Strong, aggressive orders coming in the opposite direction, confirming the turn. This might look like large prints on the tape, or big imbalances pushing price decisively away from the absorption zone.
Absorption, then initiative, like the microversion we discussed earlier.
Precisely. And third, continuation patterns. These help confirm a trend is likely to continue and offer potential re-entry spots. They often involve control strong imbalances in the direction of the trend, usually on a wide-range bar that closes strong, followed by a test price. Test price pulls back to that zone, often on lower volume, and with weaker opposing order flow before resuming the trend.
So order flow really is giving us a micro-level view of that same fractality we talked about earlier, connecting the tiny details back to the bigger Wyckoff picture.
Absolutely. The book makes that connection very clear. Those order flow turning patterns, absorption plus initiative, are essentially miniature accumulation or distribution schemes playing out tick by tick.
Wow.
Zoom out slightly, and those patterns might form the P or B-shaped volume profiles over a session. Zoom out further, and those profiles combine to create the large-scale whack-off accumulation and distribution structures over days or weeks. The underlying logic, the battle between buyers and sellers, initiative and absorption, remains the same across all these scales. It really underscores the universality of the methodology.
Okay, this is powerful stuff. So how do we bring all of this together? White-off structures, auction theory logic, volume profile zones, order flow confirmation. How do we synthesize it into a coherent, actionable trading plan? The book calls it the operating scheme.
Right, the operating scheme is the practical integration. It's a four-step process designed to build robust trading scenarios.
Analyze the context to bias directionality. First things first. Is the market currently in a sideways range, equilibrium, or a clear trend, imbalance? Your strategy depends heavily on this. In a range, you might look to trade reversals at the extremes or maybe moves between extremes if the range is wide. In a trend, you're looking to join it either confirming breakouts or waiting for pullbacks to key value zones.
Okay, context first. Then what?
Step 2, identify trading zones and levels. This is where you pinpoint specific high-probability areas on the chart using all the tools. Mark out key Wyckoff structural points, the creek, ice, spring, upthrust areas. Then overlay critical volume profile levels, HVNs, LVNs, the current and past VPOCs, value area, highs and lows, maybe the VWAP. This creates your map of opportunity zone.
Got it. Mark the territory.
Step 3, develop scenarios based on current price location. Now you plan your potential trades. Crucially, you should develop a primary scenario. If price does X, I will look for Y trigger to enter, but also an alternative scenario for the opposite direction. What would invalidate your primary idea? Be ready to adapt. The book calls this a continuous validation protocol, always asking, if this happens, then maybe that follows.
Always have a plan B.
Always. Your scenario might be a one-move setup if price is already at a key zone, or a two-move setup if price needs to, say, break a level first, then pull back and test it before you get your entry trigger.
And finally, step 4.
Step 4, position management. This is the execution. Define your precise entry trigger, your initial stop-loss placement, and your take-profit target before you enter the trade, based on the zones and levels identified in Step 2.
Let's talk about that entry trigger. What qualifies as a good trigger in Wyckoff 2.0? Something that really signals intent from the big players.
Yeah, the trigger needs to show intentionality, it could be. Pure price action. Strong sign of strength bars, SO bar, those wide-range bullish candles on high volume, closing near the top, or sign of weakness bars, SO bar, the bearish equivalent, these show commitment.
Okay.
Or using order flow within those key zones, looking for confirmation via those turning patterns, absorption plus initiative, or maybe a continuation pattern, control plus test we discussed. And an interesting technique the book mentions is using stop orders for entry. For example, placing a buy stop order just above a resistance level you expect to break, or a sell stop just below support. This acts as a filter. You only get filled if the momentum is strong enough to actually break the level, helping avoid some fake outs.
Okay, that makes sense. And how do we use these tools to set stop loss and take profit levels objectively, not just guessing?
Objectivity is key here. For stop loss, you want to place it where your trade idea is clearly invalidated. Good places are typically areas of previous rejection and, importantly, low trading activity, primarily low volume nodes, LVNs, from the volume profile. Placing your stop beyond an LVN means price would have to trade through an area where there was previously strong rejection. You might also place it beyond a key Wyckoff structural point, like below a spring, or beyond the low high of a strong Esakaso bar. The logic is, if big money is involved, they'll likely defend these areas.
Okay, defend the low volume rejection zones. What about take profit?
For take profit, you generally target zones of high previous negotiation, where price is likely to encounter resistance or find agreement again. Prime candidates are high-volume nodes, HVNs, and the VPOC of significant prior value areas. The market often gravitates towards these high-volume zones. Other potential targets mentioned are things like the developing VPOC of the current session or naked VPOCs, prominent VPOCs from previous days that haven't been revisited yet, as they tend to act like magnets.
And inevitably, sometimes, despite all this careful analysis, the price just takes off without us. It's incredibly frustrating. How does the framework suggest handling that?
Yeah, FOMO, fear of missing out, is a killer. The book strongly advises against chasing the market, against entering by momentum guided by some kind of negative sentiment, like frustration or panic.
Easier said than done sometimes.
Absolutely. But missing a move is just part of trading. Instead of chasing, view it as a validation of your initial analysis. You were right about the direction. If your underlying read of the market context hasn't changed, just wait patiently for the next opportunity. Look for a pullback to a new trading zone or a new setup. It's always far, far better to miss a profitable move than to chase it late, enter poorly, and take an unnecessary loss. And remember, this whole framework, this universality, means opportunities will come again, regardless of the asset stocks, crypto, futures, forex, or the time frame you trade, as long as there's decent liquidity.
Wow. Okay, that was an incredible deep dive. We've journeyed all the way from the foundations of Wyckoff, navigated the complexities of the modern market ecosystem, looked through the objective lens of volume profile, and peered into the granular details of order flow. It's definitely a lot to digest, but putting it all together, it feels incredibly powerful.
It really is. And if you connect it all back to the bigger picture, I think the core takeaway is the sheer power of synthesizing these approaches. It's not about picking one tool over another. Wyckoff gives you the strategic roadmap, the narrative. Auction theory provides the underlying why of market movement. Volume profile adds those objective high probability zones. And order flow gives you that final bit of precision timing for entry and confirmation.
A complete toolkit.
Exactly. It's a holistic view, really, trying to understand how institutions likely see and move the markets, which gives you, the informed trader, a potential edge.
So, for you listening, you now have a framework to approach those charts with much greater clarity. You can start moving beyond just seeing lines and numbers and begin to understand the dynamic interplay of forces, the option, the accumulation, the distribution. What this really means is developing that open mind we talked about, a flexible approach. Always validating what the market is telling you as new information, new price action comes in. It's not about predicting every single pick. Nobody can do that. It's about positioning yourself where the probabilities are highest, backed by solid, multifaceted analysis. We've seen how crucial it is to get beyond the what price went up and understand the why. Why did price go up here? Was it genuine accumulation? Was it a short squeeze? That understanding lets you anticipate potential future moves and manage your trades with a level of confidence that, frankly, few possess.
And maybe this raises a final important question for you to really chew on. If market movements are this blend of randomness and determinism we discussed, how will you personally leverage the deterministic insights offered by Wyckoff 2.0? How will you use this framework to navigate the often unpredictable currents of today's financial world? And perhaps what market behaviors that previously seemed completely random to you might now start to reveal their underlying logic as you apply these concepts?
Definitely food for thought. Excellent stuff. Until next time, keep learning, keep exploring, and keep